it's less than 1% and then actually negative from there. So it really goes to show you the impact of trying to time the market, which nobody, again, nobody in this world is an expert. Nobody has a crystal ball of what is going to happen today, tomorrow, 5 or 10 years from now. Nobody knows. And what really makes a positive impact on your money is being in the market. So rather than trying to time getting in and getting out, if you can create a plan that affords you the wherewithal and the ability to ride out these market downturns and ride the roller coaster, then that's when the true optimization occurs and your returns and the growth of your portfolio will be in a very positive light long term. But if you're not in the market, the chances of that happening is very slim to none. And I can't tell you how many people I've spoken to that, we're in the market, then they come to meet with us, they get out of the market, they're out of the market and they're fearful to get back in. And they're looking at alternatives to, address their income plan so that they can, have income without the markets telling them that they can't have income. In other words, if you're using the market just for your income as your primary income source besides Social Security, and then we have these volatile periods where the markets go down and you're being forced to sell shares at a lower price, which is essentially compounding your loss to generate that income that you need, that's a recipe for disaster. And there are much better ways, but it's just about educating yourself on the ways that can truly optimize the overall approach. And that's where we start to talk about, compartmentalizing your money and giving your money intended purpose and bucketing it into different buckets that have a different design and intended purpose so that you can ultimately stay disciplined. And that's where the behavioral psychology comes into this episode.
Yeah, I mean, you nailed it there. Um, Great points all around, and I think we run into those scenarios quite frequently where we'll meet with a client and, well, I'm just waiting to get to this point. I'm waiting to get to this dollar amount, and it just becomes this chasing game. And sometimes it's timing the market of getting in and out of it. Sometimes it's waiting till they reach a certain dollar amount to make a decision, um, and it doesn't always prove to be the best practice.
Yeah, without a doubt. I actually had a meeting yesterday with a couple. Um, they were out in Texas. Very nice couple. They've been retired for 1 year. So they tried to do the market thing with, hey, we're going to get our income out of the markets and that should all be fine and dandy. And here we are, April of 25, where sitting today, I just looked at the markets. The S&P's down about 5% now. It's actually bounced back a little bit. The Nasdaq is down about 8 or 9%, um, and that's also from after a recent bounce back. And here we are. Here this couple is, and they're 1 year into retirement, and they're trying to figure out how they're going to get income, and they've been using the market gains to source that income. And part of the conversation when we were talking about the mechanics of the income annuity is I illustrated the worst case scenario, which would be that when you activate the lifetime income benefit in the annuity, that the account value depletes to zero, over like a 13 to 15-year period. And he goes, well, if that's the case, I'll just keep my money in my IRA, and as long as I can get 7% a year, that money will never deplete to zero. And I said, sir, I said, unfortunately, that sounds good on paper if you were just going to straight line a 7% annualized return
Mhm.
and straight line it all the way down for the next 25 or 30 years. I said, but if you look at an S&P 500 chart, for an example, it's not a straight line. It looks like a heart rate. It's literally spiking and dropping and spiking and dropping every single day, every single month, and every single year. And that's the way it works. Sequence of returns over a long period of time that can have a detrimental impact on the account's overall value. If you're sourcing income and that those returns are not favorable, in other words, you're having kind of abysmal or lackluster returns or maybe even negative drops in the market over a 10-year window, and they're not on your side, those market returns are not on your side, you're going to deplete that account very rapidly. And the difference in keeping your money in the IRA and going that route versus in the annuity is that when you run out of money in the IRA, it's gone. The income stops. It's like turning off the water spigot. But in the income annuity, if that were to happen, the same exact situation, the contract for the guaranteed income rider stipulates that regardless of what happens to the account's value, if it does deplete to zero, the income will never stop. It'll continue to pay for both you and your wife as long as either one of you have a pulse. And that's where the true peace of mind comes in. And the optimization can then occur because the rest of your assets can be positioned in a growth oriented manner, being in the markets, and you can completely eliminate the timing. You don't have to time in and getting out. And as we just looked at in the Dalbar study and that article and chart from the Motley Fool, if you don't worry about timing anything and you just stay put, that's where the real growth happens. So once I kind of shed light on that, especially for the wife, because she doesn't like the markets at all, she's very conservative. They fell in love with it.